Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This is one of the last mutual fund shows of the year, and it provides us with an opportunity to look at the year gone by because certain trends emerge. It gives you some flavor as to what mutual funds have been thinking, and today I'd like to talk to you about the kind of schemes that have been launched through the year, because that will also give you some sense of what mutual funds have been intending to do and the products that they have launched and how you should respond to that, whether they've lived up to the expectations that you might have had. What we'll also do is we'll look at the performance of each category and we'll see how many schemes have outperformed the benchmark in those categories. But first, let's talk about the launches that have taken place, and let's pull up that initial set of graphics. The categories that have stood out, and we're not going through all of them, but in the equity category in particular, you have index funds and quite a few of them that have been launched, 70. These might also include fixed income, but they're mostly equity. Thematic schemes, however, and sectoral schemes rule the roost, and this was evident in the kind of flows that came through into this category. You yourself may have bought a few of these NFOs. Thematic funds, 38 were launched in the year gone by. 19 sectoral funds were launched. You also have fixed maturity plans to the extent of 19 ETFs. There were 27. There were corporate bond funds that were launched, interestingly, because they haven't found too many takers among the retail category. But you also have a lot of multi-asset funds that were launched because a lot of people found that more interesting because of the tax changes that took place at the start of the year. Debt ETFs were launched, multi-cap funds were also launched to the extent of 6, and you also had equity-oriented fund of funds in the domestic space that were launched. Now, which mutual fund houses were the most active? You'll have Tata Asset Management Private Limited, which was the most, and that is tied with Mirae Asset, 19 schemes launched by each of these. You also have Kotak Mahindra Asset Management, which is not too far away with 18. Motilal Oswal, quite aggressive as well, launching 18 schemes. Aditya Birla Sun Life, 15, followed by Bandhan at 13. Axis and Nippon both launching 12 schemes each. ICICI Prudential, 11. Grow also 11. And so too is SBI Mutual Fund, followed by Bajaj Finserv. We won't go through the whole list, but this gives you a perspective of the schemes that have been launched. Let me introduce our experts for the day. We've got Anant Ladha, who's the founder of Invest Aaj for Kal, as well as Rushabh Desai, who's the founder of Rupee with Rushabh Investment. Gentlemen, thanks so much as always for taking the time. Anant, I'll start with you. What do you make of the kind of launches that we've seen and a lot of NFOs in the passive category as well as the sectoral thematic category, those seemingly the flavor of the season? I think you are on mute.
Hi, Alex. Firstly,
Hi.
thank you so much for having me on the show. Very happy to discuss with you and feeling lucky to discuss probably one of the last discussions which we are having in 2024. See, as far as sector funds are concerned, I feel whenever we have bull market, a lot of investors get attracted by the past returns. We always try and explain to investors that you should not be guided by past returns and you should not invest purely based on it. But we can't help it. If something is beating the index or if something is beating Nifty by a lot, by a huge margin, obviously it will gain a lot of eyes and people will end up investing in those particular sectors. So that is why we had a lot of sector funds. But in last 2 months, we have actually seen decline in flows of sector funds because probably whenever market jerks or we have some volatility in the market, sector theme usually tend to take a miss, specifically if your particular sector is not performing that well. So eventually, I think as an investor, you should think whether it is suiting your risk profile or not, and then decide for investing in sectors. And as far as index is concerned, I think that is a good move. We usually see a debate saying that mutual fund versus index fund. I think we should not put versus and put and probably use both our funds in our kitty.
Good point that you're making, Anant. I want to take this to Rushabh as well. Rushabh, what a lot of people don't realize when they look at the launches that are made by mutual fund houses is that often these launches are meant to plug a few gaps in their own offerings, right? They have a bouquet of offerings. Maybe they didn't have a flexi cap fund, or maybe they didn't have a multi-cap fund, and they launched those schemes. The one category in which there is a lot of schemes that can be launched is the sectoral and thematic category, right? So why don't you explain why that is?
Hi, Alex. First of all, thanks so much for having me on the show. Yeah, you correctly pointed out that, basically, and what I concur with what Anant had to say, that, during bull markets, AMCs tend to launch a lot of new funds to garner or to attract more money into their funds. See, this is a very strategic call by AMCs, because ultimately AMCs are businesses, right? And they want to grow their businesses, and they want to attract more revenue, in their balance sheet. So, as per SEBI and AMFI's rule, you can have one fund in one category in the active space, which is, for example, say like the flexi cap category, or the mid cap, small cap category. The AMC can launch only one fund in this category. Now, in the sectorial and thematic category, in a theme based category, AMCs can launch n number of schemes. There is no limit to it. So it is very natural that, you will see a lot of funds coming in the thematic space, because ultimately, AMCs would want, more business, and want to attract investors during bull market. But it is very important to understand that, the simple plain vanilla flexi cap funds, or mid cap and small caps, if curated in the right way, they can do a phenomenal job in outbeating the markets. There is really no need to venture into thematic and sectorials, because thematic and sectorials are not only volatile, but they can be very cyclical at times also. So Alex, to put it very simply, this is a very strategic move by the AMCs to get more business and more revenue.
Now, we did play a small portion of the graphics that I intend to talk about. I want to pull that up again on the screen just to elucidate the point further. Where have the flows gone over the course of the last 7 months? And we're talking about as of November. That image that you see on your screen, we've only put sectoral and thematic because really that points out the kind of flows that you've seen. You saw peak in the NFOs somewhere in the middle of the year, that is June, July, August or thereabouts, and then you saw a bit of a slump. Of course, the market also in September, October and November has not done incredibly well, as a result of which you also see waning investor interest. But also the number of NFOs that have been launched in the sectoral and thematic category have also gone down. But what I want to pull up is the next piece of information, which is what is the quantum of flows that has gone towards sectoral thematic. As much as 40% of flows have gone into sectoral thematic. The category average returns have stood at 21.3. Let's pull up that graphic, please. 21.3%. The outperformance is 60.5%, which means that about 2/3 of sectoral and thematic schemes have outperformed their benchmark. Depends on how you look at it, glass half empty or half full, because the most launches of NFOs have been in the sectoral and thematic category, one, and two, by far and away, this is a category that has the most number of schemes. So if you think about it, 40% of close to 180, if I'm not mistaken, schemes have underperformed the benchmark, then that's not a very good picture. Anant, what do you think?
See, firstly, if 100 rupees is invested in the market, 40 going to sectors, and then almost 30 bucks going to large and mid cap, multi cap and flexi cap category is a shocking data. I personally always want that at least 50% of the total flow should go in multi-cap or flexi-cap category. That is a more stable category as far as investors are concerned. Sectors, to be true, have done really well. Specifically, I have seen that a lot of funds have been flowing to sectors like defense or maybe PSUs because of their recent outperformance. So we can't really help it, but I feel that even if you want to invest in a sector fund, choose a sector which is underperforming, because usually cycles do play out. And if you are going with a sector which has underperformed for probably last 4-5 years, you have a better chance to outperform the market, the index, or maybe gain a better performance in your portfolio. So that is my take. And I think 63% outperformance is okay as far as sector theme is concerned.
Okay, all right. Rushabh, you want to come in on that? Because 60 odd percent, I'm talking about what, exactly 60.5% outperformance. I will get the exact number of sectoral and thematic schemes, but considering it has the most number of schemes, is it an okay stat for you?
See, Alex, to look at outperformance on a 1 year basis is something I wouldn't go for it, because in bull markets, most of the funds will do well if you actually go to see. See, 60% in my humble opinion is not a great number. See, if I'm putting in money, see, ultimately we are paying an extra amount of percentage to the AMC for outperformance, right? So if I'm investing, say like some a crore or 10 crores, and if an AMC is charging me a percent and a half or two, that's a good amount of commission or percentage of income what the AMC is getting in that sense. So I would still say like 60% is still okay, but I would like to see these kind of products outperform on a rolling basis on a 3 year, 5 year, and 7 year, and see how these funds are doing. 1 year is still a very short duration, especially in a bull run. Second point is I usually don't recommend sectorial and thematic funds because it really adds no value. It's just going to complicate your portfolio. As Anant also said, I would still stick with flexi cap and multi caps, 50%. 25% in mid cap and 25% in small cap. That is what I would like to see my and my clients' portfolio in that kind of way, because sectorial and thematic funds are going to be risky and require precise entry and exit timing to get the optimum returns, Alex.
Yeah, and maybe counter-cyclical is something you should aim for, as Anant pointed out, if you are going towards that. But one thing that stood out, Anant, to me in this data is I see a flow of 8.4% going towards small caps and an outperformance of 34.6, which means that 65% of small caps have actually underperformed the benchmark. And that's quite significant, isn't it?
Very true. This year, probably small caps have not done well, but at the same time, mid caps has performed really well as data is concerned. Almost 70% of the mid cap funds have outperformed the index, which is a great number. But if we look the same data from 3 or 5 year perspective, probably more than 60-65% of the small cap funds are outperforming the index. So whenever in doubt, just zoom out and see what has happened over a better or a longer period of time, and you will get your answers. Right now, if we see last 1 year return, probably you will say that I should not invest in any small cap funds. But if you see rolling returns of last 3 years or maybe 5 years, you will find that majority, almost 65-70% of the funds are showing consistent outperformance. So you just need to look out from a longer perspective and then take an opinion, and not randomly shift your portfolio just based on a few quarters or an year's data.
Okay. An interesting trend emerging, Rushabh, large and mid cap fund accounting for 10% of the flows, large cap funds accounting for about 5%. So more people are gravitating away from the actively managed large cap category, though the outperformance in both has been quite decent. In fact, over the last year, I think one trend that has stood out is that actively managed large cap funds have been able to beat the benchmark when in past years they have struggled to do so.
Again, Alex, this is a very short-term data. What we are just seeing. See, 1 year. Of course, see, large caps, mid caps, and small caps will perform in cycles. Let's not forget that. Okay, there will be times where large caps will do well in short to medium term. There will be times where mid and small caps will do well in short to medium term. If you go to see, the past few years, large caps have struggled. Fortunately, now large caps have started to perform well. But now, if you look at the 3 year, 5 year, 7 year, and the 10 year data, large caps have really struggled. So this is the very short-term performance what we are seeing in the large cap space. Although I am very positive, yes, that it's a very good and a healthy sign that finally the active large cap space, which has been struggling for quite some time, has started to do well. But again, because the universe is very small, Alex. The fund manager has only top 100 stocks to select from and to churn into. Now I would go into an index on a traditional index fund like a Sensex or a Nifty 50. Or on the other side, there are beautiful smart beta products also in the large cap space, which have consistently done well over 5, 7, and 10 year rolling period. So rather than going into the active large cap space, I think this is a very good time to venture into the passive space in the large cap segment. coming to the mid and small cap space, I'm still very positive because India is a very,
Yeah.
very emerging economy. And I think there is huge amount of
Certainly.
potential for the mid and small cap space to outperform. Alex.
Certainly.
So,
but just to drive home that last point on the passive versus active in the large cap space, Anant, I'm curious what you have to say about this, because a lot of people gravitate, as Rushabh has just pointed, to the Nifty 50 and the Sensex. But I'm looking at the year-to-date returns, and okay, point taken, you don't look at 1 year, but then now that we're completing a year, we should also look at this 1 year. I'm not saying base your decisions purely on the back of 1 year, but take a look at it, right? I'm looking at a 1 year return for the Nifty 50. It's at around 10%, give or take a couple of bips here and there, right? I'm looking at Nifty Next 50, which is 27% plus right now. So if you had a combination of the two, you would have done much better than just a Nifty 50. Is there a case to do a 50-50 split?
Absolutely right, and a very interesting point put forward. See, if we check out the underperformance of index, main reason is few heavy-weighted stocks have not performed well. But will they continue to underperform on a 5-year basis? Probably we can't answer that right now. So we need to see and based our decision based on logics and based on data. And as rightly mentioned by you, I also feel instead of doing maybe a large cap fund, you can probably shift to large and mid cap as a category, and that is bound to outperform. Or if you are interested in index, probably you can do Nifty 50 and a combination of Nifty Next 50. I personally like Nifty Next 50 more because those stocks have to work hard to get into Nifty 50. They have competition. They tend to do better on results, and they have more expansion opportunities. So as far as that is concerned, I think having 50% exposure in Nifty Next 50 along with Nifty 50 is a better combination.
Okay, certainly. On the chart, of course, you're only seeing Nifty 50, but then Nifty Next 50 has done incredibly well. It caught my attention a couple of weeks back. I also want to ask you guys about what you think about the rupee, right? Because we've seen a 2.7% decline. I don't know what the rate is today, but as of Friday, it was a 2.7% decline in 2024 against the US dollar. We dropped to a record low on Friday. And I'm sure a lot of people that have overseas travel or have requirement of transacting in dollar will perhaps keep one eye on that. Is there a way to, through your investments in mutual funds, adjust for that and hedge against that, Rushabh?
Alex, absolutely. I mean, over a longer period of time, we have seen that the depreciating rupee has added anywhere between 2 to 4% returns, in the investments which investors make, either in the Indian mutual funds which invest in both Indian and US, or the Nasdaq 100 or S&P 500 product, right? So I think having some exposure anywhere between 10 to 20 or 10 to 25%, either in a S&P 500 or Nasdaq 100, or like a product called Parak Parak Flexi Cap Fund, which invests in domestic equities as well as the US equities, is something what I really, really encourage, because over the past 10 years, what we have seen that is the Nasdaq 100 is actually outperformed many of the Indian indices. Although US and India will perform in cycles, but I think geographical and currency diversification is absolutely very important today.
All right. Do we have the split chart ready for the Nifty 50? Okay, let me know when it is. In the meanwhile, because I just want to drive home that point. It's very visible in the chart. But let's move to the questions that we've got. And I also want to put that number on the screen so that people can send us their messages. By the way, if you're sending us a question, make sure you tell us your name, your location, as well as the goal that you're saving towards, because this will help Anant as well as Rushabh to answer your questions better. Siddharth, who is 38 years old, is looking to put in a 70,000 rupee per month SIP. And he's got a time horizon of 15 years with a goal of accumulating 5 crore rupees. Some funds that he should look at this stage. Anant, of course, the most important factor of those 15 years is to increment his investment. But he's starting with a sizable chunk, 70,000 rupees, nothing to sneeze at.
Absolutely right. It's a good start, but probably he'll be needing investment of 1 lakh a month. So probably he can increase his SIP as and when his pocket allows. Good start can be to invest in a flexi cap or a multi-cap category with a combination of small cap funds. Probably right now, looking at the valuation of small cap, we might see some volatility in that segment, but since he's just starting his SIP, I think volatile time will be good because he'll be able to add more units to his portfolio. So that can be a combination. Plus, he has to keep in mind that eventually he will be required to increase his SIP or step up his SIP as and when it's possible for him.
Do you want to name a few schemes, not necessarily a recommendation, but schemes that you like in the categories you mentioned?
See, for example, multi-cap category, I'll name a few schemes. We can look at Kotak and ICICI multi-cap. They have consistently outperformed. It's not an advice because I don't know his risk profile and his mindset as of now, and I don't have all the details. But these two funds have done really well. And if we are looking at small cap as a category, probably we can even look at Edelweiss fund. They are doing consistently well.
All right, so a few ideas for you to invest in, Siddharth. Hopefully that helps. By the way, we have those two line graphs for you just to drive home the point of what I was saying. Let's pull that on the screen, Nifty 50 and Nifty Next 50 in the year-to-date period, because that will give you some perspective on how they have been. There you go. So there's been a consistent outperformance of the Nifty Next 50. Both are considered large cap because the classification by the AMFI is the top 100 stocks based on market capitalization, and this includes all of them. Let's talk about Rajesh's question next, and he's also looking for suggestions on how he can allocate his SIP with the intention of reaching 2 crore in 10 years. That's a very sizable corpus that he's looking to build in a very short period of time, and he's not really given us how much he can invest. Rushabh, just with those variables in place, 2 crore in 10 years with an SIP, even if you assume an aggressive 13-14% rate of return over the course of that period, what is the kind of investment he has to make?
See, Alex, assuming 12% is CAGR returns over the next 10 years in equities, Rajesh will need to invest 1 lakh rupees per month to achieve 2 crores. Now, this is a pre-tax number, right? So if I would suggest, see, 1 lakh is a huge chunk, so either if he has that kind of capacity, 1 lakh rupees per month, or doing a step up, is something what I would highly recommend, anywhere between 10 to 20%. But yes, 1 lakh rupees per month is something what he will need to do currently.
Is 12% an achievable target? I ask because even relatively conservative equity investors over the last 4.5 to 5 years have managed 15 plus. So therefore, is 12% the right benchmark, Rushabh?
See, it's better to be conservative, Alex, because ultimately at the end of the 10th year, 9th and the 10th year, how the markets pan out, that will actually determine whether it's 12% or 14% or 15% plus, So it's better to be a little conservative today. But of course, I do believe that 15% is quite easily achievable if markets pan out to be really well.
Okay. All right. So there you go. So it's better to be conservative. You'll end up having more money than you intended to have, or you'll achieve your goal faster, which is never a bad thing. And you can reset it higher. Maybe buy something that you like. All right. So let's go to the next questions. Surajit Ghoshal has got the next question. He's 62 years old and he's invested 25 lakh in the SBI Balanced Advantage Fund and 2 lakh rupees in the SBI Large and Mid Cap Fund. Both are regular growth funds, he points out. And he would be redeeming it in 2027 for his son's marriage, which is in another couple of years. Should he switch both to direct? It's a bit of an odd question. Anant, do you want to first very quickly talk about the difference between direct and regular? Ultimately, it's the same scheme. It's just that he's paying a distribution fee.
See, before answering this question, I have a very interesting data for you, Alex. I still remember in Jan or Feb of this year, we did a show on your show only, and we discussed about importance of having exposure to Nifty Next 50 also as an index, and we compared a lot of index funds in that show. I think that would have played out really well for the investors. As far as difference between regular and direct is concerned, in a direct fund, there is no distributor who is involved, and in a regular fund, there is a distributor who is taking care of all the processes for you. See, it completely depends upon your mindset. If you think that you are a well-versed investor, you don't need any help or you don't need any guidance, then you can shift to direct. But if you think your distributor has done well and he has guided you well, and you still need some guidance and some insight into the funds and managing of that funds, I think regular is also good. So it completely depends from person to person and his own expertise in the market. If you are an expert and you know everything about markets and how to place your fund and how to switch it, probably you can also shift to direct. It's absolutely okay.
Okay, Rushabh, you want to come in on this very quickly because I'm just trying to pull up the difference between the balanced advantage direct and regular in terms of the expense ratio, just to drive home the point. But you want to come in on that while I pull that up?
Alex, I more or less agree with what Anant had to say. But at this point of time, he's nearing to his goal. In the next 2 to 3 years, he's actually going to redeem the mutual funds, right? So I think rather than experimenting right now, shifting from regular to direct or any other fund, that is not something what I would recommend. I mean, just stick with whatever he has at this point of time, because the goal is going to come out near. See, I pulled out some very interesting data saying that what is the actual difference between a regular return and a direct return. It's actually anywhere between 0.5% to 1% on an average. Of course, over a longer period of time, it's going to make a good amount of difference between the returns and the amount. But since the goal is coming quite near, I think sticking put to what products or what options he has is something what I would recommend.
Okay, very quickly to drive home that point, the expense ratio on the regular balanced advantage is 1.57%. On the direct, it is 0.67%, and so the differential is 90 basis points. Approximately 25,000 rupees per year over the next couple of years is what you're paying more in the form of a regular versus direct. So maybe something for you to bear in mind. Of course, you'd be paying tax when you move from one to the other. So see if that makes sense. Anant, Rushabh, thanks so much for joining in, for giving all the advice that you did. Pleasure having you.
Thank you so much, and a happy new year in advance.
Wish you both the same. All right, and that brings us to the end of this particular edition of the Mutual Fund Show. It's been an absolute pleasure bringing it to you. Do stay tuned. Lots more coming up on NDTV Profit.